OMG, the world is ending again. For like 900th time. The U.S. unemployment rate just jumped to 4.3% in August, the highest level since October 2021. Youth employment jumped to an insane 10.8%. There simply isn't jobs for new grads anymore because AI is taking all the jobs. On the surface, this all sounds catastrophic, and we're probably going to have pretty big reckonings with the employment crisis and AI here in the next few years, but that's not for today. Rising unemployment does mean an economy is heading towards a kerfuffle. Recession, potentially. Recessions are bad for financial markets. At least that's what we're all taught about in economics, right? But in today's upside down economy, and things have definitely been upside down for a long time in the economy, higher unemployment may not actually be the bearish indicator that it once was. In reality, this could be the spark that lights the next leg of the bull market. And I'll tell you why. Because, well, one, the economy is not the markets. Okay, there's that. But the headlines love to scream, AI is taking all the jobs. People on YouTube make videos about that crap all the time. And there's some truth to that. Salesforce literally axed 4,000 customer support roles this year due to AI efficiency gains. And a Stanford study found that early career workers in AI exposed industries saw a 13% drop in employment. If you're 22 and trying to break out into the job market, maybe you want to be an analyst or a junior marketer, shit, dude. You're competing with a $25 a month AI subscription that never sleeps and is better than you. Sorry, it's brutal, but that's the truth. Here's the nuance though. Economists say AI's overall labor impact is still small, but definitely not zero, and it's going to grow exponentially. The tech sector makes up only 5.8% of the workforce, so the bigger driver right now is economic uncertainty. Businesses don't know what the Trump administration's next move is gonna be. What's gonna happen with trade? What's gonna happen with tariffs? What's gonna happen with taxes and spending and all that kind of stuff? Will they ever release the certain files about a guy who used to run a certain thing on an island one place one time? That's why the U.S. got a disappointing 22,000 jobs added in August versus the 75,000 that economists expected. That's why we had a gargantuan jobs revision too in March. Well, it wasn't Trump's fault. That was Biden's fault. But anyway, still, people are worried about the jobs market right now. Workers right now are doing what's called job hugging, clinging to what they have, while others are quiet, quitting, completely disengaged, but too scared to quit. Here's where the disconnect begins. Rising unemployment should mean weaker growth, but the GDP keeps just raging. 3.3% last quarter, estimated 3% this quarter. Thanks to AI and automation, productivity is still climbing. A UK survey by Lloyds found 59% of major financial companies reported higher productivity from AI last year, and more than half plan to boost AI investment again. Companies are doing more with fewer people. Again, the economy is not the stock market. Big tech isn't broke. They might be cutting back on hiring humans, but they're still pumping billions into AI. What Zuck the other day just said, we're going to dump $600 billion in the next 2 years into data centers. A lot of growth areas in the markets and in the economy, and the cash hasn't disappeared. It's being reallocated away from labor and into machines, fueling productivity gains and keeping margins healthy. Rising unemployment isn't crashing the system yet. The engine is still running. It's just running on different fuel, and the tank for the employment markets might be getting a bit low. But anyway, where exactly will the money keep flowing? How will it keep the GDP growing? And why is it so bullish for assets in the next few years? Well, it's an important piece of the puzzle. So if unemployment isn't taking the economy yet, then where's all the money going? Well, it's a very interesting question. We'll answer that for you in a second. However, before we do that, guys, if you're trading these markets, you want to trade AI coins, Solana, Ethereum, Bitcoin, dog coins, whatever, you need a good place to do that. Place is BitUnix, okay? No KYC, no VPN, no BS. It means anyone, anywhere can use it. Crazy deals right now, too. You get 30% off on fees, exclusive when using the link down below with a VIP 3 trial. You get up to $400 in deposit bonus to deposit $2,000 or more, $400 cash back money in your account. Crazy deal. Insane trading bonuses. And for the whole month of September, we are giving away $1,000 every live stream, Monday to Friday, to new signups. That could be you. You could be in to win. Link down below. Go check it out and start trading the way you should with freedom. So, the money question. Where is it being redirected? Well, it's being redirected into investment, government spending, into net exports. These are the contributors to the GDP that actually move the needle when consumption is weaker. When it comes to investment, companies are in a full-on arms race right now for AI build-outs, data centers, onshoring, the energy transition are sucking in trillions of dollars of investments. And by the way, I think these are some of the biggest growth sectors in the stock market world. AI, data centers, robotics, and energy. Don't fade those sectors. Different story. Anyway, just days ago, Meta alone announced it's pledging $600 billion to 2028. That's a big deal. They're not alone. All the other big companies are throwing just gargantuan sums of money at the AI issue right now. That's invisible to consumers, but moves GDP. Layer on top billions more from Microsoft, Amazon, Nvidia, Tesla, OpenAI, Oracle, everybody. We're talking a tidal wave of liquidity. The money that might have gone to salaries is now powering machines and infrastructure that boost productivity and ultimately corporate earnings, which keep the stocks rallying, even though the jobs market looks kind of like a big bag of dicks. When it comes to government spending, the Trump administration, their new spending, this big bill they've got, is going to boost the deficits by $3.4 trillion over 10 years. More debt, baby, let's go. That's cash flowing straight into infrastructure, into defense, subsidies and all kinds of other stuff, effectively injecting jet fuel into the GDP. They're splashing money everywhere. It's not just the USA. Almost every country in the EU has significantly increased their spending, particularly on defense, as a percentage of GDP in response to the ongoing American and sort of broader NATO warnings over everything going on in Ukraine right now. And so, what about a recession? When it comes to net exports, tariffs, and onshoring, it's all reshaping the supply chains currently. U.S. manufacturers are suddenly stronger exporters, and net exports are already ticking higher. So while consumers on Main Street have been forced to tighten their belts because there just doesn't make good jobs available right now, the economy itself is being propped up by massive corporate and gargantuan government spending. These big players right now are spending enough to keep the GDP absolutely cooking. Again, 3.3% growth last quarter, 3% estimated for this quarter. That spending will continue to fuel liquidity and asset price growth until the music stops. And the music will stop at some point, but that's for later us to worry about. Right now, us should worry about making sure we're adequately allocated to the markets to ride this wave. Here's where the story gets ruthless, though. The rising unemployment cycle is brutal for workers that trade their time for money, but glorious for investors that own assets. The playbook is simple. Main Street will continue to suffer as more jobs get taken by AI and robotics. Jobs will vanish, wages will stagnate. Young workers will compete not just with each other, but increasingly with algorithms that never sleep and with humanoid robots that work 24 hours a day, never miss a shift, never get drunk, never run over a cat on the way to work and have to call in sick. Then we have the Fed cuts. Rising unemployment gives them the political and economic incentive to lower rates and pump fresh liquidity into the system. Liquidity floods the markets, cash chases returns, asset prices inflate, stocks, real estate, and of course, crypto all will ride that wave. When the Fed finally cuts rates, which they're likely to do next week, they'll not only be doing this into rising unemployment, but also into higher than normal inflation, combined with rising productivity gains. It's a heady cocktail. But thanks to AI, thanks to automation, and thanks to CapEx spending, output is rising even as labor costs drop. So, in theory, the Fed can inject liquidity without triggering a collapse in supply. And that, if they manage to pull it off, rocket fuel for markets, baby. And you're already seeing markets price this in with gold heading towards $3,700 at the time of recording this video. Historically, of course, Bitcoin tends to follow gold's lead. We've got a video about that. Make sure you go watch it. The markets are telling us liquidity is coming, baby. And the bull market, it's still raging. But let's be clear. All of this isn't really good news for everyone. Workers are getting squeezed. If you're a regular worker and you don't have exposure to all of these risk assets that benefit going up in price, you're in trouble. The social contract is breaking, and the long-term implications, we're talking 5-10 years down the line for the AI and robotics employment Armageddon. Fuck. Anyway, wealth is being transferred from labor to capital at a pace we haven't seen in decades. And it's going to be even more of a situation of haves and have-nots, so make sure that you have. When unemployment spikes, assets skyrocket, but only for those holding capital. The headlines look scary, but the truth underneath is the opposite. This is the perfect storm for asset owners and for investors. Fiat is being debased, corporate productivity is climbing, and government and corporate spending is keeping the GDP growing. Labor markets, it's a different question right now. And how labor markets continue to react to AI and robotics is probably not going to be great, and it'll continue to be a concern over the next years. But as long as money keeps flowing, prices will keep going up. That's why crypto stocks and other hard assets are positioned to rally while Main Street feels the pain. Rising unemployment in 2025 doesn't signal doom for markets, it signals opportunity for investors, but only if you know where to look. The cycle has been merciless for workers, but mercilessly bullish for those holding the right assets. And you can say, well, but this is all unfair and this is bullshit. And look, technology is not stopping. Did we all sit around and cry a bunch of tears when the CD industry was obsoleted overnight by digital music? No, we just went and bought our little iPad player or whatever things the heck were called back in the day. Remember those little things? Had the music in it. It was great. 100 CDs on one little card thing. It's amazing. Anyway, getting off topic. Change comes. Adapt with the change. Invest in the change. Ride the wave, baby. Thanks for watching.